Having evaluated the Fed's minutes of the June policy meeting, Wall Street is ready to revise its forecast of a rate hike in July. The market is adjusting the Fed's stance to economic data. ADP employment data sheds light on the labor market conditions, and the government data will be released on a Friday. Market sentiment on Wednesday depended on the Fed's minutes. The hawkish signals pushed the stock indexes down. The Dow Jones lost 129 points or 0.38%, the Nasdaq lost 0.18% down, and the S&P 500 shed 8 points or 0.20% to close at 4,446 points. The major indexes traded on a pessimistic note in the New York pre-market. All of them went lower into negative territory, and the S&P 500 is expected to trade in the intraday corridor between 4,370 and 4,440 points. The Fed's minutes dampened market sentiment yesterday, and the policymakers agreed to maintain the status quo at the policy meeting in June. They need more time to assess the impact of previous rate hikes and decide whether further increases would be appropriate. While some voting members wanted to continue raising the funds rate in June as the progress on taming inflation was slow, almost all policymakers found it appropriate or acceptable to keep the federal funds rate at its current level of 5 and 5.25%. Most participants noted that keeping the rate unchanged would give them more time to assess the progress of the economy. Most officials noted that uncertainty about the outlook for the economy and inflation remains elevated, and that additional information would be useful to consider moving forward, the minutes read. Forecasts released after the June meeting showed that 16 out of 18 officials still expect the funds rate to be increased by at least another 25 basis points by the end of the year. Markets have changed a little since the minutes, and futures traders pegged to the Fed's interest rate are still betting on a rate hike in July and give a one-third chance of another hike before the end of the year. Market sentiment on Wall Street is also sensitive to the trade standoff between the United States and China. The Philadelphia Semiconductor Index fell by 2.2%, Intel shares sank by 3.3%, and Texas Instruments shares dropped by 1.8%. However, there was also positive news. The showdown between Musk and Zuckerberg sent Meta shares up 2.9% ahead of the expected release of the company's Twitter rival app, Threads. At the New York pre-market, the story continued. Meta shares rose by 1.7% after attracting millions of users within hours of a Threads launch. However, closer to the opening of the market, the shares pulled back, but maintained an increase of a plus 0.3%. At the same time, most mega capitals went down at the beginning of the pre-market trading. Shares of Alphabet, Apple, and Tesla slipped by 0.8% and 1.9%. Wall Street's ultimate test will come with the 4 critical indicators in the still surprisingly vibrant U.S. labor markets, 2 of which have already hinted that market optimism will face yet another tough test. Private businesses in the United States unexpectedly created 497,000 jobs in June, the most since February 2022, and well above forecast of 228,000. Besides, wage growth was slowed both for those who change jobs and for those who stay. Consumer-facing services had a strong June. However, wage growth in these same indicators continued to weaken, and hiring is likely to be at its peak after a sharp end-of-cycle rise, said Neil Richardson, chief economist at ADP. Moreover, the number of Americans filing new jobless claims increased moderately last week, indicating only gradual cooling in the labor market. Initial claims rose by 12,000 to 248,000 last week, beating forecast by 3,000. The strength of the labor market was highlighted in the separate report released Thursday by global employment firm Challenger, which said U.S. employees announced 40,709 job cuts in June, down 49% from May. Companies announced 187,793 layoffs in the second quarter, down 31% from January to March. As for the JOLTS vacancies data for May, it will be released today after the opening bell. According to the consensus, it will show a decrease in the vacancies in May, and the government NONFARM employment report will be published on Friday. Last but not least, the review of ISM business activity in the United States and for June and the speech of Dallas Fed President Lori Logan will complete the picture of the day. In the corporate news, stocks of the chip maker Qualcomm and Intel continued to fall, dropping by 1.2% each. Shares of ExxonMobil shed 0.9% on a signal of a sharp fall in operating profit in the second quarter due to the lower natural gas prices and lower refining margins, according to a regulatory report. The US dollar had a volatile session yesterday, and its index slipped from 103.40 to 102.90 and rebounded. The instrument traded at 103.20 or 0.12% down in the pre-market. The intraday CAD for the index is seen between 102.70 and 103.5. The US dollar rose against other major currencies on Wednesday as the minutes of the Fed's June policy meeting bolstered the expectations for another rate hike in July. Nearly all Fed officials agreed to keep interest rates unchanged last month, and most of them are expected to greenlight further tightening in July. We still have a lot of work to do, New York Fed Chief John Williams said on Wednesday, referring to stubborn inflation once again. At the same time, despite the growth on Wednesday, market sentiment changed today. In fact, the minutes reflected that what investors already knew, and there was no place for new horror stories in them. Futures for Fed rates proved market resilience, and the futures have changed a little since the publication. At the same time, the yield on a 2-year US Treasury bonds rose closer to 5%. In effect, the dollar index is stuck somewhere between believing in a strong economy, a soft landing, and a subtle feeling that the tightening cycle is coming to an end. Besides, the state of affairs in Europe looks a little worse, so the ECB is a little more hawkish. It's too early to write off the index. The labor market remains the main bone in the throat of risk takers. The US dollar may regain its luster at the end of this week. Given that the employment picture is not yet complete, the momentum of the dollar movement has not yet gained full strength. The Canadian dollar is losing ground against the US dollar, and the USD CAD pair climbed by 0.34% in midday to trade at 1.3320. The intraday CAD is seen between 1.3290 and 1.3370. The economic data released today is challenging the strength of the Canadian economy, and Canada recorded an unexpected trade deficit in May as the energy and grain exports declined, Statistics Canada data showed on Thursday. The trade deficit stood at 3.44 billion Canadian dollars, the largest since October 2020, following a downwardly revised $894 million surplus in April. Analysts had predicted a surplus of 1.15 billion Canadian dollars. Total imports increased by 3% in May, breaking a 3-month decline in a row, supported by raw gold, silver, platinum, group metals and their lows. Imports of cars and spare parts also contributed to growth, rising by 4.5% in May to a record high of 11.3 billion Canadian dollars. Total exports declined by 3.8% over the same period, mainly due to cheaper energy as well as wheat and canola. Oil prices remained virtually unchanged on Thursday as the market faced a reduction in the supply of crude oil and fears of a slowdown in the global economy. Brent oil futures fell by 0.10% to $76.50 per barrel, and WTI shed 0.2% to trade at $71.50. The crypto market is optimistic today. Bitcoin jumped to the highest level in the last 13 months. The price surged by 3.28% to trade at $31,500, but it did not stay there for a long time. The token traded at $31,100 in the midday and also slipped later on. Before the opening bell, the price was already at $30,500. Most popular altcoins traded higher in the midday, except Binance. Sadly, all of them reversed downward in sync in the pre-market. The world's largest cryptocurrency recently found support from plans by fund managers, including BlackRock, to launch a US-listed Bitcoin exchange-traded fund. In an interview on Wednesday, BlackRock CEO Larry Fink described Bitcoin as a global asset that serves as a digital counterpart to gold. Fink suggested that instead of relying on gold as a traditional hedge against inflation, investors should consider Bitcoin, as it also provides a hedge against currency devaluation. Under Fink's leadership, BlackRock is actively implementing Bitcoin ETFs in partnership with the Coinbase. It remains unclear whether the Securities and Exchange Commission will approve the proposed ETF, as previous applications have been rejected. However, Fink's positive comments about Bitcoin have helped to limit the fall in the token's price. Among other things in the market, the Commodity Futures Trading Commission investigators concluded that bankrupt crypto lender Celsius and its former CEO, Alex Mashinsky, had violated US rules before the firm collapsed. According to the report, lawyers in the regulators' enforcement department found that Celsius was misleading investors and had to register. If a majority of the panel members agree with the finding, the agency could file a lawsuit in the federal court this month. Speaking about Bitcoin's intraday outlook, if the asset managers to hold the $30,500 high, it will rise to $31,500, after which it can easily cross the $32,000 level. And the alternative scenario looks like a decline to $30,000 and even below. That's all for now. Subscribe to our channel and make profits with the InstaForex. See you online tomorrow.